Hello and welcome to the New York State Life Review webinar course. My name is Carrie Dine. I'm going to be your licensing instructor for today's webinar. I'm going to go over a couple of quick things with you. Definitely I encourage active participation because the more engaged you are, the more information you're going to retain. Also, that cool little device that you probably have in your hand right now, your phone, can you please put it on mute or turn it off? It helps alleviate any background noises or any distractions. Also, you should schedule your exam within 5 days of completing your PFSU class. And it doesn't matter what your educational level is or how much you know about financial services, because your pre-licensing courses, they're designed to meet you where you are and to help you get where you want to go, which of course is a life licensed representative. We have a bunch of highly qualified licensing coaches that are here to help guide you through the entire licensing process, from what you need to do before class to also what you need to do after you pass your exam and get your license. If you have any questions, definitely write them down and review them with your coach. At the end of the webinar, you'll get my personal email address, and if you have any questions, you can also feel free to email me as well. So, during this webinar, right, it just wanted you to know that it is not a certified course, okay? This is not what you need to do in order to pass your exam. This is just a review course. You should have already attended PFSU, and this is just a review. Would also help if you had with you your licensing insurance manual, as well as your personalized study plan. What we're going to be going through in today's webinar is we're going to be going through your life insurance policies, as well as your policy provisions, options, and riders. Okay, this is a huge chunk of your exam. It's 20% each, which is a total of 40 questions on your state exam. All right. Plus, these are the two chapters that you're going to be using the most out in the field during your career. So I'm going to try to make it as easy and as simple as possible for you to remember the differences between policies and what makes them special and unique. So let's get started. There are two different types of policies. Before I go any further, I just want you to understand. We have what's called temporary insurance and permanent insurance. Temporary insurance is exactly what it says. It's temporary. It's for a short period of time. That's term insurance. You have permanent insurance, which is exactly what it says. Permanent. Covers you from the time you get it to the time you die, age 100, whatever comes first. A permanent insurance policy has an insurance component and a savings component. Now, there's different types of permanent policies. They all have the same concept, meaning insurance and savings combined, but what makes them different is how the savings component of that policy works. And I'm going to get into that in just a second. So let's get started with some term insurance. Okay? We have term, whole life, flexible premium policies, variable life, specialized policies, group life, and credit life. And again, all of those I'm going to go into detail with you to help make it easy for you to determine what type of policy is what. Term insurance. Okay? There's three different types of term insurance. You have level, increasing, and decreasing. Now again, term insurance is temporary insurance because it covers you for a specific period of time. There's no cash value. The policy expires at the end of the period. It provides the highest amount of coverage for the lowest cost. And a term policy only matures if the insured dies during the contract period. But if the insured dies outside that time frame, there's no death benefit paid. You can always tell how the death benefit works by the first word before the word term. So you have level term, increasing term, and decreasing term. Level term means the death benefit stays level the entire time. Increasing means the death benefit increases over time. Decreasing means that it decreases over time. Here we go. Just to reiterate, level term. This is the type of term policy that's called level term because the premiums and the face amount stay the same. Increasing, it increases over time. Increasing term is usually used as a rider, okay, to add additional coverage to an existing policy. Decreasing term, because the death benefit decreases, it's usually used in credit insurance, and it to keep pace with a debt like a mortgage or a loan. All the while, in all three policies, your premiums remain level. Some of the features that we have for term insurance, well, we have something called annual renewable term. This type of term insurance, this renews each year without having to prove insurability. But every year, your premium goes up because why? Because you get older, okay? Now, at the end of your term policy, you have three choices, okay? You can renew it, you can convert it, or you can cancel it. But we're not going to talk about what happens when you cancel it. We're going to talk about renewing it or converting it. So renewing it means that at the end of the term, you can renew it without proving insurability for another term policy. All right? Some term policies, they're not renewable, okay, and a new policy has to be taken out, and you'll have to prove insurability. If we convert it, that means you're going from term to permanent. You're going from a term insurance policy over to a whole life policy. Again, you don't have to prove insurability, but your premium is going to go up because you just got older. Okay, your attained age, you're now older. So let's talk about permanent insurance. I'm going to start off with whole life. Okay, permanent insurance covers you, like I said, from the time you get it to the time you die or age 100, whatever comes first. All right, it grows cash value, your premiums are level, it endows at age 100, which means that the policy's ended, and your cash value now equals your face amount. Okay, and the policy owner or the insured gets a nice big check from the insurance company. All right, if the insured dies before age 100, then only the death benefit is paid, not the cash value. So with permanent insurance, again, you have insurance and a savings, and you combine them. The difference between the different types of permanent insurance, again, like I said, is how your cash value works. In a whole life policy, your cash value has guarantees to it. All right. What we're going to talk about now is we're going to talk about the different ways you can pay your premium for a whole life policy. So the actual insurance policy is the same. It's just you pay your premiums differently. You can pay them continuously, limited, or in a single premium. Continuous premium, that's the most basic form of whole life insurance. You're going to come across this all day, every day, okay? Somebody has whole life, typically this is the type of policy that they have. All right, they get it at 25, well guess what, they're paying premiums every single month until they're 100 years old and the policy endows. All right, they remain level, and the face amount also remains level. Now, let's say you want coverage forever, but you don't want to pay forever. That's a limited pay whole life policy. It has a shorter premium paying period. Again, it endows at age 100. There's two examples of limited pay policy that you might see. One is called a 20-pay life, and the other is life paid up at 65, LP65. Okay, those are two examples. So 20-pay life, that means you have coverage forever, but you're only paying premiums for 20 years. A life paid up at 65 means that you're covered forever, but you're only paying premiums until age 65. Premium payments are higher because you're not paying as long, but your cash value also grows faster. But let's say you have a whole boatload of money, and you only want to pay one premium at inception. You want coverage forever, but you never want to ever pay a premium ever again. That's a single premium whole life policy. Okay. Main difference is that the entire premium is paid up in one lump sum. It grows immediate cash value, right? But again, it also remains in force until age 100. And then we have what's called universal life. Same concept as whole life, meaning it's an insurance and a savings combined, but it works a little bit different. With universal life, this is considered an unbundled product, right? You have two ways, and it also has a flexible premium, and you can decide how you're going to pay your premiums. You have a minimum, and you have a target premium. The minimum premium is what you need in order to keep the policy in force. However, a target premium is what it's said to not only keep the policy in force, but also grow your cash value over time. So let's say we choose $50. Well, our $50, boom, it goes into this bucket, and this bucket is our cash value. With universal life, right, we have our insurance component is actual annually renewable term. And what did we say about annual renewable term? Well, it goes up each year. As your age goes up, so what happens? Your premium goes up. So let's say we're just paying $50 a month, all right? All that money, boom, is going into our cash value. What else is going into our cash value bucket, into our cash bucket? Well, some interest, because the company, we can get the current interest rate, okay? That's our interest. But once a month, something's got to come out, right? We have expenses and fees that come out, all right? Also, our insurance. Part of our fees is the insurance, and it's annually renewable term. And what happens? Over time, as you get older, the cost of insurance rises. So the cost of insurance gets bigger. That insurance bucket is getting bigger. And eventually, there's not enough money inside your first bucket, which has your cash value in it, to sustain what it's going to cost to insure you. Because again, the cost of insurance goes up each year. And eventually, the universal life policy will implode because there's not enough cash value to keep the policy in force. Some trigger words that you can use for universal life is flexible premium. It has something called a waiver of a cost of insurance, which I'll get into more detail of that later, where in the event you become disabled, it'll waive the cost of insurance, which is the annual renewable term. You have a minimum premium and a target premium. There's a contract interest rate. You can get the current interest rate. The insurance component is annually renewable term. Also, there's something called option A and option B, which I really want to touch briefly on that. Universal life is the only type of life insurance product where you actually have a choice, where you can get option A, which is the level death benefit, which is just the death benefit, or option B, B for both. You can get both the cash value as well as the death benefit. That is a very expensive option, and the majority of people that you'll come across don't have that. There's also something called the corridor. That's the difference between your cash value and your death benefit. That's what the company actually has to pay, because you get one or the other, you don't get both. And with universal life, there's something called a partial surrender or withdrawal as opposed to policy loans, because when you take that money out, it's not considered a loan. Now, we're going to touch base on variable life. Again, same concept. It has an insurance and a savings component, but what makes variable life different is how the savings works. A variable life product is actually an investment. All other life insurance policies are not investments, because all you need is a life insurance license to sell, solicit, or negotiate them. But a variable life policy, you have to have a securities license, okay? Have to have your life license as well as the securities license. The insurance component of it, right, it's level and fixed premiums, but the face amount can increase or decrease. And there's a guaranteed minimum death benefit. But the investment, again, the cash value is an actual investment. And because of that, it's held in the company's separate account. The policy owner actually gets to pick from a portfolio of stocks and bonds. But the cash value, again, it's not guaranteed because it can increase and it can decrease based on the investment results. And the policy owner, they bear all of the risk inside of this investment. So let's look at the difference between variable life and universal life. Well, universal life has permanent insurance with renewable term protection component. It's flexible, and the premium has a minimum or a target premium. The face amount is also flexible. That's set by the policy owner with proof of insurability. And the cash value, it's guaranteed at a minimum level, and it's in the company's general accounts. The variable life, that's a permanent insurance. Doesn't have a term component. The premium is fixed or flexible. It has the face amount, it can increase or it can decrease. And the cash value, it's not guaranteed. Why? Because it's an investment. In both cases, you can take out from that policy cash value. Now we're going to talk about specialized policies. Don't worry and don't get confused. Okay, these are not brand new different types of policies. With any one of these policies, the underlying insurance can be any type of insurance. Could be term, could be whole life, could be universal, could be variable. Okay? Specialized really just means what the policy does. Let me explain. So you have joint life. A joint life policy is based on 2 or more lives. All right? And how do they figure out the premium? They take the joint average age. A joint life policy pays a death benefit upon the first death only. So it could be a term policy, it could be a whole life policy. It doesn't matter. All right? If it covers 2 or more people and it pays upon the first death, it's a joint life policy. You have survivorship. Survivorship covers 2 or more people. Again, premiums based on the joint average age. But however, survivorship life insurance is used, it pays upon the last death, and it's used to offset the liability of estate taxes. Okay, again, to help prevent against, inheritance taxes, to help pay for that. Because, again, what did I say? A lump sum death benefit is not taxable. And then we have life insurance on minors. In New York State, it states that a minor who is at least 14 and a half, they can own their own policy. Any below 14 and a half, they can't. But their beneficiaries has to be their parents, their grandparents, brothers, or spouse. Okay? Typically, it's a parent. And very briefly, we have something called a fixed equity index life. Okay, this is where, again, it's a permanent policy, insurance and savings, but the savings component, the cash value, is based on the performance of an S&P, like an index like the S&P 500. But there is a guaranteed minimum rate in there, so it's not considered an investment. It's only a life insurance license that you need to sell it. And the face amount can increase annually to keep pace with inflation. Then we have group life insurance. For those of you that have ever worked for a company that offers a life insurance product at an extremely discounted rate, that's what this is. All right, it's written for an employer. All right, it's for the employee groups, labor unions, credit unions. It can be contributory where only 75% of the people use it, or non-contributory, in which case 100% of the company has to be involved. They typically use annually renewable term insurance because it's the purest and most inexpensive form of insurance. Because it's underwritten as a group and not on an individual basis, the participants don't have to prove insurability. The employer or the group sponsor, they receive the master contract, and the participants or the employees, they receive what's called a certificate of insurance. They have no say as to what goes on inside or outside of this policy, only who their beneficiary is. Now, let's say someone leaves that group, but they want to keep their insurance. They have the right to convert it to an individual policy within 31 days. However, they have to be on the plan for at least 5 years, and they have to convert it to a whole life policy. And then there's credit life insurance. Credit life insurance is written to insure the life of a debtor to pay an outstanding balance of a loan. It could be an individual or group insurance, but they usually use decreasing term insurance. I like to use my mom as an example here. A little Italian lady, we call her Knuckles. You borrow money from Knuckles, well, you have to pay it back, and she always wants her money. So let's say we borrow $100,000 from her, and God forbid something happens to me, and I become an angel before I get to pay it back. Well, she's out that money, and she wants it back. So she would require you purchase a decreasing term insurance, so that, again, in the event I become an angel, she recoups whatever money is still outstanding. Got to give Knuckles back her money. The creditor owns the policy, and the beneficiary of the policy, and is also the beneficiary of the policy, but the borrower would pay the premium. So Knuckles, she would be the owner and the beneficiary, but I would pay the premium. Unfortunately, Knuckles wouldn't be able to receive anything more than what is owed to her. Okay? The creditor only receives the balance of the debt, because again, insurance is not meant to gain, but only to indemnify in the event of a loss, right? We've got to make whole, not profit. So that comes to the end of our life insurance policies portion. I hope I made it a little bit easier for you to understand the difference between the different types of policies. If you slow down and you actually take a look at it and break it down. It's not that complicated. But again, this is going to be the most important part of what you learn because it's 20% of your grade and you're going to be using it a lot in your career. So I'm going to go over a couple of questions. I hope that you take my advice, and before I answer the questions, I hope you pause it and try to answer them yourself to make sure that you've retained some knowledge during our visit together. So we're going to start with number 1. Which of the following is not a characteristic of term life insurance? It provides temporary protection. It pays a death benefit if the insured dies during the stated period. It's the least expensive form of life insurance, or it builds cash value. Your answer is D, because term insurance does not build cash value. What type of policies build cash value? Permanent insurance policies, like whole life, universal, variable. Which policy would be most appropriate for protecting the balance of a loan or a mortgage? Level term, decreasing term, whole life, or convertible term? Your answer is B, decreasing term. Remember, we use that for credit life. Knuckles has to have her money. Decreasing term keeps pace with the debt. How long does coverage continue for a limited pay whole life policy? 20 years on a 20-pay policy. 65 years on a life paid up at 65, death or age 100, 10 years on a 10-pay policy. It's death or age 100, because you remember, see those words right there? Whole life policy. Just because it's a limited pay, all that means is you're only paying for 20 years, but you're covered forever. An insured has purchased a $100,000 whole life policy. After a period of years, the cash value of the policy has grown to $42,000. If the insured dies at this time, how much will the beneficiary receive? $100,000, $142,000, $42,000, or $58,000? Unfortunately, it's only $100,000 because with permanent insurance, with whole life insurance, you only get one or the other. You never get both. Only the death benefit or the cash value, whichever is greater. Which of the following is incorrect about universal life? The policy owner may increase or decrease the face amount. The insurance portion is whole life. The policies allow for partial withdrawals or surrenders. There are 2 death benefit options, option 1 or option 2. Your answer is B, because the insurance portion is not whole life insurance. It's annual renewable term. Policy that insures 2 or more lives and pays on the death of the last insured is a joint life, group life, survivorship life, or universal life. Your answer is C, survivorship life. An easy way to remember this is survivorship life is second to die. So who is the beneficiary of a credit life policy? The debtor, the insured, the debtor's family, or the creditor? The creditor. Remember what I said. Who needs their money? That's right. Knuckles needs her money. All the following are eligible for group insurance except single employer groups, labor unions, a group of neighbors, or fraternal organizations. A group of neighbors. They can't just get together and say, hey, we're going to get together so we can get cheap insurance. It doesn't work that way. A group has to be formed for a different reason other than getting inexpensive insurance. Which of the following types of policies allows for partial surrenders? An indexed whole life, universal life, whole life, or limited pay? It's universal life. That is the only type of permanent insurance that allows you to take a partial surrender and you don't have to pay it back. Premiums at renewal of a term policy are based on the original age, the attained age, the average age, or the renewal age. It's your attained age, okay, which means at the time of renewal how old you are. If it's 10 years older, well, guess what? You're paying a 10-year older rate. It's your attained age. An indexed whole life policy's interest rate is usually linked to an equity index, such as the Moody's Corporate Bond Yield, Consumer Price Index, inflation rate, or Standard & Poor's 500. The S&P 500. Every time you see those words equity indexed, okay, I always want you to think of S&P 500. Just a trick. When converting a group life policy to an individual life policy, all of the following would be true except the right to convert is typically 31 days. No proof of insurability is required. The individual policy will have the same face amount as the group policy, or the individual policy will always be the same type of insurance as the group policy. Your answer is D, because at the end of a group policy, when you're converting it, you're going from annually renewable term, you have to convert it to a whole life policy, and you have 31 days to do that without proving insurability. And that concludes our policy portion of our webinar. I hope I shed some light on it for you, made it a little bit easier. And right now we're going to get into your provisions, your riders, and your options. These right here, this section, again, 20% of your test, and you're definitely going to be using this information out in the field. So let me break it down for you as easy as I can. Your provisions, those are your rights and obligations inside the policy, okay? Riders, those are any things that you want to add on to a policy to make it unique to you. And then your options, those are your choices that you have with regards to what can happen with the money inside the policy. And there's 3 different kinds of money. You have your cash value, your dividends, and then the death benefit. And we're going to talk about those in a minute. So we're going to first start off with your provisions because, again, those are your rights inside the policy, the rights of the policy owner. So now there's no standard, they're not all the same. There's no law saying, oh, it has to have this, it has to have that, but they're pretty much like universal. Again, they're your rights and obligations of the policy owner. They protect the policy owner. They're also called clauses, right? It's just your basic things. So the biggest one is the ownership provision. The ownership provision states that he or she that owns the policy has all of the rights. Okay, meaning they can change the beneficiaries, they can borrow cash value, and they can assign the policy. And that's a big deal because assignment means that they can change or transfer the policy ownership. You can do an absolute assignment or you can do a collateral assignment. Now, an absolute assignment means that you do a total transfer of all of your rights. Typically, that happens in the case of a divorce when you have a husband and a wife that are on the same policy, or you have a husband that owns a wife's policy, or vice versa. In the event of the divorce, instead of having to get a brand new policy, they can just do an absolute assignment and transfer that rights over. You can do a collateral assignment, which is partial or temporary rights, usually done to repay a debt or a loan for somebody who's uninsurable. And then you have the entire contract. Really what the entire contract states is you have the issued policy plus the application plus the riders all bundled together with a nice big staple, and boop, that's your entire contract. Also, inside your policy, it also has to state how you're going to pay your premiums, because premiums are paid in advance to the home office. Now you have your choice as a policy owner how you're going to pay them. You can pay it monthly, quarterly, semi-annually, or annually. Again, the higher the frequency, meaning the more you pay, the more you end up paying in the long run. Annual premiums, again, are the least expensive. Now, in the beginning of your policy, you have what's called your right to examine. That is your free look provision. It's kind of like your money back guarantee, we like to call it. This is where the policy owner, they have 10 days to say that they don't like the policy, and they can receive a full refund of any of the premiums that they paid if they're dissatisfied for any reason. Okay, it begins when the policy owner receives the policy, and that's 10 days. When you as the agent go and sit down with the client and deliver that policy, once they sign it, boom, that's when it starts, 10 days, unless they were mailed, and then that's 30 days if it's by mail. Now, let's say if your client loves the policy and they want to keep it. Well, you know, things happen, and sometimes we change bank accounts or aren't able to pay the premium on time. There's something called a grace period. This is 31 days after the premium is due that the policy owner has to pay that premium before it lapses. We have a grace period to protect the clients, to protect the insured against the unintentional lapsing of a policy. But, you know, what happens if someone dies during that grace period? Let's say it was due on the 1st and they pass away on the 15th before they have the chance to pay that. Well, the company actually pays the death benefit, they just minus whatever premium was owed to them. 61 days for flexible premium like universal life. Now let's say the policy does lapse, okay, and goes past the grace period. Well, client, the policy owner, has the right to reinstate that policy, okay? That means that they can bring it back to its original state. But they have 3 years to do that. And when they do that, they have to prove that they're still insurable, and they have to pay back any overdue premiums, any loans, or any interest. Now, there's something in the beginning of your policy. It's called the incontestability period. This allows the insurance company a certain time frame where they can challenge paying a claim because of material misrepresentations on the application. All right, I hope you remember that a material misrepresentation can void off a contract. All right, and the company doesn't have to pay a claim in the event of fraud or lying or concealment. Right? Got to make sure that you're writing good business. Now, the incontestability period, that's the first 2 years of the policy. And it begins at the time of issue. Well, what happens if a client misstates their age? Well, it's not really that big of a deal. Okay, what happens is if they misstate their age, they just change the death benefit. Why is that? Well, because if they were given insurance in the beginning, they were obviously insurable, all right? But what the company will do is they will adjust the death benefit to the amount of the premium that that money would have paid based on that age. A couple of more provisions. Well, statements on the application, they're deemed to be representations, not warranties. Proof of death. Let's hope in your career you never have to file a death claim, but when that happens, you have to provide a copy of the death certificate, a proof of loss form, okay, and that has to be turned into the company. And then if there's no beneficiary that's named or even alive, then the death benefit is paid to the estate. Claims must be paid immediately upon receipt of any written proof of a loss, usually within 30 days. And your job as an agent is to make sure that this process goes quickly and smoothly as possible. There's something called exclusions. Now, what an exclusion, remember how I just said that your incontestability period is the first 2 years of your policy? Well, that means that a company can deny a claim if it happened within the first 2 years. Well, after those 2 years, a company can also deny a death claim based on these 4 things. Now, not all companies do, but they could if they wanted to. all right? And those 4 exclusions are war, aviation, suicide, and hazardous occupations or hobbies. I like to say hazardous fun stuff, okay? Now, give you an example. Everybody remembers 9/11, okay? Well, in the weeks that followed, if you remember, you heard on the news that a lot of insurance companies weren't accepting death claims. They weren't paying out. Well, that's because they had what's called a wartime exclusion clause, which means in the event someone dies from war, the company doesn't have to pay out because that's catastrophic. That's huge. And a lot of insurance companies would go out of business if hundreds of thousands of people started to die in the event of a war. Now again, not all companies have these exclusions, but they could. Again, war, aviation, suicide, and hazardous occupations or hobbies. Aviation, we're not talking about the people that fly the big planes. We're talking about that special breed of people that own their own little planes with the little propellers and props that usually end up crashing into mountains. Yep, those people. Suicide, that's self-explanatory, and hazardous occupations or hobbies. Some companies could deny a death claim if you die while skydiving or bungee jumping or have a hazardous occupation like somebody who washes the windows on the high-rises in the city. Those are your standard exclusions. Now, we're going to talk about beneficiaries. Beneficiaries can be anybody that the policy owner wishes to name. It could be an individual, like Bob and Susie Smith. Could be a class, like my children, my grandchildren, my nieces, my nephews. Could be a trust. Could be an estate. Could be a minor, not recommended, but could be a minor. So we have what's called a primary beneficiary and a contingent beneficiary. The primary, well, they're the first person to get the money. Contingent, that's your backup plan. They receive the death benefit if the primary dies before the insured, or even in the event of a common disaster. You have something called a revocable beneficiary as well as an irrevocable beneficiary. A revocable beneficiary is your typical beneficiary, which you're going to come across. They can be changed at any point in time. However, an irrevocable beneficiary could not be changed without their signature. So it can't be changed without their permission. So that's pretty tricky and it's very testable. So it'll ask you, can an irrevocable beneficiary designation be changed? And your answer is not without their consent. Typically, an irrevocable beneficiary, where you would see this again, is in the case of a divorce, where it's court-ordered. And then something like I just mentioned was the common disaster clause. This is where the insured and the primary beneficiary are in a common disaster, like a car accident or a plane crash or something, where they can't determine who died first. They have the Uniform Simultaneous Death Act, which states that regardless of who passed away first, it said that the primary beneficiary dies first, in which case the contingent beneficiary would receive the death benefit. Policy loans and withdrawals. This only applies to cash value policies, not term. This is where the policy owner can borrow up to the cash value, but not the face amount of the policy, because remember, the cash value will never exceed the face amount of a policy. You can only borrow what's in the savings. Any outstanding loans are deducted from the death benefit. So let's say you have a $100,000 death benefit, you took $10,000 out from your cash value, and you become an angel 2 weeks later. Your beneficiary will receive $90,000 because you borrowed 10. Any loan request can be deferred up to 6 months unless it's paid in premiums, unless it's to pay the premiums, I'm sorry. Policy loans are not taxable because it's a loan. Universal life policies, they allow for partial surrenders for a fee, but they don't charge you interest. An automatic premium loan is something handy that you could have when you have a cash value policy. This is where this helps prevent the unintentional lapsing of a policy, where the amount of your premium will come out of your cash value to pay for your premium if you can't pay for it. Now we're going to talk about the different types of riders. Okay, so those were your provisions, those were the rights inside your policies. Now we're going to talk about what you can add to a policy to customize it to you. See the cool little pizza with all the little mushrooms and stuff, right? You can add it to how you like. We have a waiver premium, a waiver cost of insurance, which is only on universal life, a disability income benefit, a pay your benefit, which is for juvenile policies, accelerated living benefits, which allows you to take a portion of your death benefit in the event you become terminally ill. You can also add additional people to your coverage. You can have an accidental death, guaranteed insurability rider, a cost of living rider, which increases your policy a tiny little bit due to inflation, a return of premium, as well as term riders. Which toppings do you want on your pizza? So let's talk about your disability riders, right? Let's get more into detail. Your waiver of premium, this is very typical. You're going to see this a lot, and you'll be able to do this on your policies as well. This is, of course, it costs more money. Anytime you add something to make it special, it costs more money. So you have a 6-month waiting period. This is where your premiums are refunded after those 6 months, and the company will waive all of the future premiums that are need to be paid. If you have a cash value policy, you will also grow cash value. But a waiver of a cost of insurance, like I said, is only on universal life. And because universal life is annual renewable term and that cash account put together, it only waives the cost of insurance. You will not grow cash value. A disability income, this not only waives the cost of, not only waives the premium, but it also provides a monthly income to the insured in the event they become disabled. You have a pay your benefit. Like I said, this is for a juvenile policy. When you see that word PAYOR, just a little hint, it always talks about a juvenile policy. This is rider, it attaches to a whole life policy that's written on a juvenile, where in the event of the adult dies or becomes disabled, that premium is waived. You have a guaranteed insurability rider. This is an extremely expensive rider. It expires at age 40, but this allows the policy owner the right to purchase additional insurance at specific dates, like when they get married or when they have kids, or every 3 to 5 years, and they don't have to prove insurability. So again, very expensive rider. Then you have an accidental death. An accidental death pays an additional benefit, but only for the losses that are accidental, not due to sickness. Remember we talked about that word to indemnify, to make whole? Well, an accidental death rider would allow for double or triple indemnity, which would pay double or triple the face amount in the event of someone dying in an accident. But again, the death also has to occur within a specified time frame, usually 90 days. We can also cover additional people. We can add our spouses to our policy. You know, this is, again, add our spouses onto one policy so we don't have to purchase an additional policy. We can add our children to a policy. And you have a family term rider. This is attached to policies where it covers families. Let's talk very quickly about the different riders that affect your death benefit. The accelerated or living benefit rider actually allows you to receive a portion of your face amount, portion of the death benefit, should the insured become terminally ill. All right. It'll also help cover, it helps cover, you know, medical and living expenses before someone passes away. Now, you don't forfeit the remaining death benefit. It's actually paid to the beneficiary upon the insured's death. What increases your death benefit? We have a cost of living rider. Sometimes it's called, you know, just the COL. This increases the coverage. You don't have to prove insurability. It goes up a tiny little bit. It's usually tied into, you know, a consumer pricing index. And again, your premium will go up a tiny little bit, but it's based on your attained age. They have a return of premium. What a return of premium rider is it's an increasing term policy that's tacked on to usually a whole life policy, which states that if the death occurs before a certain age, all the premiums that have been paid into the policy along with the death benefit will be given to the beneficiary. And, you know, this rider usually expires around age 60. So that's it for our riders. Now we're going to get into your policy options. So we talked about your provisions, which were your rights. We talked about your riders, which is what you can add to a policy to make it special to your needs. Now with your options, these are your choices. The choices that the policy owner has to make in regards to the money. Okay? We have 3 different types of money inside a policy. You have your non-forfeiture options. That is another word for cash value. They call it non-forfeiture because it can't be forfeited. They can't just take your money from you without any reasons. It can't be forfeited. You have dividend options. A dividend option is if you have a policy from a mutual company. A dividend is a return and an overcharge of premium. It is not taxable and it is not guaranteed. So if you have a policy, a participating policy, you have choices as to what you can do with your dividend. And then settlement options. Settlement options, that's the end of the policy. Unfortunately, someone has passed away and we have to determine what to do with your death benefit. They call it a settlement option because you're settling a contract. That's why it's called your settlement options. So I'm going to talk about what you're going to do with your non-forfeiture options if you own a permanent policy and decide that you no longer want that policy. You have 3 choices. Okay? I'm going to start at the bottom first. Cash. You can just get a check. Very simple. Company sends you a check, they minus any type of surrender charges that are there, but when that happens, the policy cannot be reinstated and your contract is null and void. All right? If this also happens, part of that payment can be taxable, but part of it could not be. It all really depends on what the policy owner has paid for premiums over the years. If they paid more in premiums than they get back, then it's not taxable, okay? They can use that cash value, let's say, if they still want insurance, okay? The cash surrender is if they don't want insurance anymore, but let's say the insured still wants insurance. They have 2 choices. They can take that cash value and they can exchange it, okay, for a single premium policy with the same, it's the same type of coverage, but a lower face amount. That's a reduced paid up. So what that means is you're reducing your death benefit, but now you have a paid up policy, a permanent policy. They could take the cash value and use it as a single premium term policy, in which case the face amount stays the same, but the length of time is shortened, and that's extended term, okay? So a little acronym for that is REC, R-E-C, reduced paid up, extended term, or cash. All right, again, if they can take a check and run, that's cash. If they still want coverage, they can reduce the death benefit, but purchase a paid up policy, that's reduced paid up. Or they can keep the same death benefit, but have a shorter time frame, which is extended term, okay? If you have a policy, if you have a participating policy, then the policy owner has choices as to what they're going to do with their dividends. What did I say a dividend was? It's a return of an unearned premium, it's not guaranteed, and it's not taxable. And there's different things that you can do with that dividend. Well, cash. Just take the check and run. Okay, go shopping, do whatever you want with it. You can use that dividend to reduce your premium, reduction of premium. What that does is that reduces next year's premium. Okay, so if you're paying $1,000 for premium every year, if the company issues gives you a $100 dividend, you add that to next year's premium, and next year you're only paying $900. Reduction of premium. You're reducing next year's premium. You can leave it there and let it accumulate interest. This is where the company keeps the dividend, however, they give you the interest that is earned on it. Now, dividends are not taxable, however, interest is. So accumulated interest. You can use your dividend to purchase paid up additions. What paid up additions are is it increases your death benefit. Okay? You use your dividend to purchase a single premium policy of the same type, meaning more whole life, but you're getting it at a reduced policy amount. Okay? You can also use your dividend to purchase paid up insurance. What that means is that you're taking that dividend and you're not adding it to next year's premium, you're adding it all the way to the end of the policy, okay? So it shortens your premium payment period. So instead of paying to age 100, maybe you're only paying until age 90 or age 80, okay? They use the dividends to pay the policy up early, which means no additional premiums are going to be required to continue the policy to age 100. Or you could use your dividends to purchase 1-year term insurance. This also increases your death benefit, but it only increases it for in-year increments. Okay? So again, cash, reduction of premium, accumulated interest, paid up additions, paid up insurance, or 1-year term. Your settlement options. Again, like I said, your settlement options are what's going to happen with the death benefit. How is it going to be paid? Your acronym here is CLIFF, C-L-I-F-F, okay? So what are the choices? Well, the beneficiary can take a cash lump sum, a one-time payment. And what did we say? A lump sum payment of a death benefit is not taxable, okay? So they can take a check and do with it what they please. They can also do what's called a life income. A life income is where they take the death benefit and that money is actually put into what's called an annuity. An annuity is paid for the life of that beneficiary, but the payments stop when they pass away. It's based on the life income that they choose. And there's a couple of different choices that they have. They can do a life with period certain, a life with a guaranteed minimum, which all offer different guarantees. Then you have what's called interest only. This is a temporary option. This is where the proceeds are held by the company. They accumulate interest, and the beneficiary receives the interest on a monthly basis until they decide what they're going to do with it. Now again, the death benefit is not taxable, but any interest is. Now let's say the beneficiary only wants money for a specific period of time. They can choose what's called fixed period installments. Again, this money is placed into an annuity and the proceeds are paid over a fixed period of time, like 10 years or 20 years. Now the dollar amount is paid, it's determined by the death benefit and the time and the period of time which is chosen. So if someone says, hey, I need money for 10 years, the insurance company is going to determine what that payment is actually going to be. But what if somebody only needs a certain amount of money each month to replace someone's income, right? They can choose what's called a fixed amount installment. This is, again, where the proceeds are put into an annuity and the proceeds are paid in equal amounts until all of that money is paid in full. Now, the length of time is determined by the insurance company because it depends on the death benefit and the amount of payment, that has been chosen. So again, your settlement options: cash, life income, interest only, fixed period, or fixed amount installments. So let's take a look at our options again. Our non-forfeiture options. Non-forfeiture is really just a fancy word for cash value. Okay? If you have a cash value policy, a whole life policy, and you want, and you're done with the policy, you have choices as to what you can do with your cash value. If you still want insurance, you can use your cash value to purchase reduced paid up insurance, which means your death benefit is lowered, but you now have a paid up whole life policy. You can use your cash value to purchase extended term, which means you extend the death benefit. You have the same death benefit, but it's only for a specific period of time. Term, extended term. So you've kept the death benefit, but shortened your insurance time frame. Or you can take a cash surrender. Okay? Get a check. You can cut and run, go shopping, whatever you want with it. Those are your non-forfeiture options. Your dividend options. Again, if you belong to a mutual company and which issues participating policies, you as a policyholder are entitled to policy dividends, which are a return and an overcharge of premium. Again, they are not guaranteed and they are not taxable. If you receive a dividend, you have choices, your options. Cash, you can take a check and you can just run. You can use that dividend to reduce your next year's premium. Reduction of premium. That means you're not paying as much next year. You can leave it with the company and let it accumulate interest. Your dividend is not taxable. However, the interest that you accumulate is. You can use it to purchase paid-up additions, which means you're increasing your death benefit. You can also use it, even though it's not shown here, you can use it to purchase paid-up insurance, which means you're adding that dividend to the end of your policy at age 100. So you're not paying premiums forever. Okay? You're limiting your policy, how long you have to pay it for. And last but not least, you can use it to purchase one-year term insurance, which also increases your death benefit, but only for 1 year time frame. And then your settlement options. Okay? What do we do with our death benefit? How can the beneficiary receive that? They have choices. First one is cash. They can take a lump sum payment and cut and run and do whatever they want with that money, right? A lump sum death benefit, again, not taxable. But let's say they want to put that money away because they want money forever. Maybe they're not good with money. They can use it to purchase what's called an annuity. And the annuity will give them an income forever that they cannot outlive. It's a life income. They could also leave that death benefit with the insurance company for a temporary time period and do what's called get interest only. It's where, again, the death benefit is not taxable, but the interest that they receive is. But let's say they only want money for a fixed period of time. Let's say they only need money for the next 10 years. Well, they can take that death benefit, put it into a short-term annuity where they'll receive payments for the next 10 years or 20 years, whatever they designate. But let's say they need a specific amount of money each year, whether it's $20,000 or $50,000 or whatever they need, they can take that money again, put it into a short-term annuity, and the annuity will pay them that set amount of money until all the money is gone. That's fixed amounts. And I hope I've clarified some things for you and made it a little bit easier for you to understand. Right now we're going to get into some questions. Again, I'm going to read the question. I'm going to read the answer to you. I advise you to hit pause, try to see if you can figure the answer out for yourself. But again, I will explain it and go over it. I'd love to see, how much you guys have retained. So number one, what type of assignment would be used for a loan? Is it collateral, absolute, modified, or permanent? The answer here is collateral. We have a collateral assignment because that's partial rights. You're assigning partial rights. If a policy owner should return a policy 7 days after the policy was delivered, the insurer will refund the prorated portion of the premium paid, refund the premium paid minus expenses, refund nothing because the insured was covered for 7 days, or refund the full premium paid. Well, they're going to refund the full premium paid because remember what I said, the first 10 days after the policy has been delivered, that's your free look, right? It's like your money back guarantee kinda. It's your right to examine the first 10 days. The insured can return that policy and all their premiums will be refunded. If an insured dies during the grace period, the insurer will pay the full face amount, the face amount minus premiums due and interest, the face amount minus the surrender charge, or nothing, because the contract is null and void. B, the company is going to pay the death benefit, but they're going to have to take their premiums, what's owed to them, out first. Which of the following is not a requirement of a reinstatement provision? To submit the reinstatement application within 3 years of the policy lapsing, proof of insurability, pay back all loans, or pay back premium at the current attained age. Your answer is D. You don't have to pay your premium back at your current age. You pay the back premiums, which are the premiums from when you first got it, which was at the beginning age, not at your age now. If an insured dies 3 years after the policy was issued and understated his age on the application, what will the insurer do? Will they adjust the death benefit, pay the full death benefit, adjust the premium, or pay no benefit and return the premium paid? They'll just adjust the death benefit because in the beginning they were already insurable. Okay, they just adjust the death benefit based on their actual age. What is the name for the first beneficiary named in a policy? Primary, secondary, tertiary, or contingent? Primary. Primary always means one. They're the first person who gets the money. Which dividend option would be taxable? Reduction of premium, paid up additions, cash, or accumulated interest? Your answer here is D, because even though dividends are not taxable, any interest that you earn on them is. Which non-forfeiture option, if chosen, prohibits reinstatement of the policy? Cash, extended term, reduced paid up, or interest only? That's cash. If you take a check, then you're done. You are not allowed to reinstate that whole life policy. Which of the following riders functions like a waiver of premium but is found on a juvenile policy? Cost of living, return of premium, disability income, or pay your benefit? Your answer is pay your benefit. Remember I said anytime you see that word pay your, P-A-Y-O-R, it has to do with a juvenile policy. How long must the policy owner be disabled to receive benefits from the waiver of premium rider? 1 month, 3 months, 6 months, or 12 months? 6 months. And what happens after that 6 months? The company will reimburse your clients their premiums, and henceforth their premiums will be waived. Which of the following riders could an insured increase the death benefit when he married with no proof of insurability? Spouse term, accelerated death benefit, cost of living rider, or guaranteed insurability? That's your guaranteed insurability rider right there. And remember, this rider is very expensive because, like the question says, they don't have to prove insurability and they're allowed to increase their death benefit at specified dates or events inside their life, like when they get married or when they have children. All of the following riders would affect the death benefit amount except accidental death, waiver of premium, cost of living, or return of premium. Your answer is B, waiver of premium, because the waiver of premium doesn't affect the death benefit. It affects how you pay your premiums. That's it. It allows you to waive your premiums in the event you become permanently disabled. And that concludes our webinar for today. I want to thank you so much for allowing me to help you through your licensing process. I want to go over a couple of things with you real quick before we end. please, please study at least 15 hours for your state exam. I mean, you don't want to have to take the exam over again if you don't have to, and there's no reason for it. There's so many different types of study materials that are at your fingertips. You can complete your personalized study plan. It's there for you to use it how you see fit. Make sure you review the Pass Now on Primerica online. There's a ton of different materials for you. You have the life study guide map. You have exam videos. You have that Terms for Success, flashcards. There's test-taking tips. It's insane the amount of things that they have for you just to help ensure your success, okay? When you take your practice exam on Primerica Online, you definitely want to go green, okay? Because when you go green, that's pretty much going to ensure that you're going to pass your exam, okay? Again, we want you to pass it on the first time. So thank you again for completing this course with me. If you have any additional questions, please feel free to email me. And if you need any additional study time, your licensing coach is definitely there to help you. That's what we're here for, okay? Make sure you take advantage of all the study tools that are available to you on Primerica Online, including Pass Now. Take your practice exams, take focused exams, get ready, you know, get your license. We're excited to be here for you. I look forward to hearing from you. My email is carridey@primerica.com. Again, that's KARI.DEY@primerica.com. Definitely want to hear from you. If you have any questions, give me a, you know, shoot me a quick email.